In last week's video, we went over a pretty dramatic example of how a trader could have entered into a particular option strategy known as the iron butterfly, and how on a slow market day, like you'll often see in the middle of the summer, you'll get an incredibly high return on your capital because the market is slow and trading in a tight range. Well, this week we're going to answer the question, what happens if the market starts out slow and then in the middle of your trade it suddenly takes off in one direction or the other? Are you just a sitting duck and you're destined to lose money on that trade? I'm the head trader of S&P Capital's options trading desk here in Manhattan, and believe me, the traders on our desk, like the rest of you, I'm sure, are not exactly in love with the idea of being a sitting duck as a trader. And so we develop ways to defend our positions, which can be incredibly effective once learned. So if you're interested in a technique to save an options trade which is going south on you and instead turn it into a solid winner, then stick around, because I think you're going to find this to be an important solution for those situations. Hi, I'm Seth Freyberg, and I'm the head trader of S&P Capital's options trading desk. S&P Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so in our video from last week, we showed you a recent pretty dramatic example of how much money there is to be made on slow trading days, and slow days do typically occur in the summer when a lot of people are taking it easy or on vacation. And so the very time that day traders are struggling to find solid trading opportunities, options income traders can be having their best months. Now, last week, we taught you a one-day options income strategy known as the Iron Butterfly, which we'll review again in a minute this week to catch you up if you didn't see last week's video. And in that video, we explained that if on a slow day in the summer, a trader executed an Iron Butterfly trade using index options at the beginning of the day, that as long as the market stays in a small range around the opening price of that index and closes fairly close to where it opened, then the trader would be able to make an incredibly high return on his capital that day. In fact, it was over 40% in last week's video. Okay, so after we posted the video last week, we got a lot of questions from traders who asked the very logical question, well, what if the index does move a lot from its opening price? Do you just lose money on the trade? So basically you put on your trade and then just pray that the market stays in a small range that day? Well, that is obviously not much of a trading plan. And so the short answer to that question is no, you don't just sit there and allow yourself to lose money without putting up a fight. There is a corrective action that can solve the problem much of the time, and we'll explain how all of this works in a minute. Now, before we do that though, we'll need to make sure that everyone watching this video understands how index options work. This is going to be quick for those of you who already understand index options, so hang in there and we'll get back to the repair strategy for an Iron Butterfly in a minute. Okay, so almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before that option expires, and a put option that entitles you to sell 100 shares at the strike price of the put option before that option expires. But there are also index options, which work similarly to equity options, except there's no such thing as 100 shares of an index like the S&P 500. You can't really buy or sell 100 shares of an index, but what you can do is get paid in cash, $100 per point, if the index expires above the strike price of an index call that you buy, or alternatively, you'd pay $100 per point for each point the index drops below the strike price of your index put. So for example, if an index is trading at 3150 and you buy the 3160 call, if the index closes at 3165, you'd receive $500 in your account. If the index closes at 3610 or lower, on the other hand, your call expires worthless. On the other side, if you buy a 3135 put and the market sells off to 3125, you'd make $1,000. But if the market just sold off to 3135 or higher, the put would expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will allow you to sell options as well. And your broker will allow you to put together combinations of options. In other words, options strategies that involve both short and long options purchased in a way that is advantageous to you as a trader. Okay, so with that as background, let's head back to June 17th, which is a Wednesday. Now, SPX options expire every Monday, Wednesday, and Friday. And so on this particular day, the June 17th options were expiring. And so let's take a look at what would have happened had we executed an iron butterfly trade on that day. Well, the SPX index opened that day at just about exactly 31.35. So the way that this one-day trade works is that you sell both a call and a put at a strike price right at the market opening price of SPX for options expiring that day. And then for protection, the trader would move up 25 points to the 31.60 call and down 25 points to the 31.10 put and go ahead and buy both of those. So this structure, this sequence of short options at the money in the middle and long options, also known as wings, out of the money, this structure is what is known as an iron butterfly. So let's first take a look at the cash flow implications of this trade so you can understand how this opening trade will affect the cash in this trader's account. So we paid $7.07 for the long call at 31.60, and remember that call is worth $100 per point above a closing price of 31.60, and so you multiply that by $100 for a total cost of $707. Now we sold that 31.35 call for $18.05, and so as you can see by the calculation, that brought in $1,805. And we also simultaneously sold the 31.35 put for $1,734 for a cash inflow of $1,734. And finally, we bought the 31.10 put for protection for $8.30, thus costing us a total of $832. So when you net everything down, you end up with positive cash flow of, coincidentally, in this case, exactly $2,000. And the amount your broker will require for this trade is $500. So that's the amount of capital you'd be putting to work to enter this trade, which you need to know if you'd ever decide to actually entertain a strategy like this. Now, before we get into how this trade goes wrong and the fix we're going to use to repair it,
I wanted to let you know that there really are sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective technique that some of the greatest investors in the world like Warren Buffett use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it.
okay, so now back to the iron butterfly trade from last month. It's important to understand that the way you win on this trade is when the market stays inside a certain range of prices around the opening price of 31.35. And in this case, that range is 31.15 to 31.55. Now, what is the reason that you make money at any point inside that range? Well, with an iron butterfly trade, in more than 99% of the cases, at the end of the day, you will owe money under either the short call or the short put that you sold, because unless the market closes exactly at 31.35, you will owe something under one of those 2 options that you're short, because it's binary. The market has to close either above or below 31.35, as those are the only 2 realistic outcomes, except for the rare fluke where it closes precisely at 31.35. And so if you think about it, there's a range of outcomes where you would make a profit on this trade, as you can see, at any price above or below 31.35, which is where we sold both the short call and the short put, as long as the SPX doesn't move more than 20 points above or below 31.35. But sometimes the market, even on a sleepy summer day, is going to make up its mind to bust out of that 20-point range. And so either we resign ourselves to losing money in those cases, which is a very bad idea, or we implement a strategy to what we call repair the trade in options income trading terminology. Okay, so now let's move forward to about 3:30 that day. And as you can see, the SPX is now sold off beyond the downside profit range limit of 31.15. And so if the market keeps going down or just stays at this level, the trade will lose money, as we explained before. So in this case, what we'll do is to perform what is known as an adjustment to options income traders, and we'll buy what is known as a put side butterfly. So let's break down each component of this put side butterfly. So you can see that we are buying the 31.35 put. Well, that means that we're no longer short that put. We have negated that position by buying it back. Just like if you're short shares of a stock and you go out and buy those shares, you have negated your short position in that stock. You have no position. And so that 31.35 short put, that just goes away. And then you'll see we did something interesting at the 31.10 strike. Remember, we're long that put. And so what we did was we sold two of those puts. We sold the original put that we owned at 31.10, but we also sold a second one. So we not only are no longer long that 31.10 put, we're actually short that put because we sold a second one. And then finally, we bought a new long put down at 30.85. And so if we look at the effect of this move after the adjustment has been executed, you'll see that we're now short and long the same options on the call side. That hasn't changed, but on the put side, we're now short the 31.10 and we're long the 30.85. In the original 31.35 short put, that's just gone because we bought it back as part of the put side butterfly adjustment. So now this new structure is known as an Iron Condor to options traders, where the short call is above the market and the short put is below the market. Now, before we see how this trade concluded, let's make sure we understand that this put butterfly adjustment wasn't free. It had a cost to it, and that cost is shown here. So you can see that the cash outlay for that 31.35 put minus the cash received from selling those two 31.10 puts plus the small amount which we needed to pay for that 30.85, if you net it all down, it comes to a total cost of $14.18, which is a pretty healthy chunk of the original $2,000 in cash that we received. But nonetheless, we still have $582 left in cash flow with 30 minutes to go before the market closes and all these options expire. Okay, so now let's move forward to the end of the day. And you'll see that the SPX is now closed at 31.13, which you'll note is between the short call and the short put. So now turning to how each of these options will settle, you'll see that all of the options actually expired worthless because the calls both expired above that final SPX price of 31.13, and the puts all expired below the 31.13 closing price. And so since none of those options had any value, then the remaining cash flow of the trade that you retained after the put side butterfly adjustment we just did, well, you get to keep that as your trade profit. Now, what I'd like you to do is to compare this profit of $582 that you just made to what would have been the case had you not done the put side butterfly adjustment and you left the trade in its original iron butterfly form like a sitting duck. Well, let's take a look back at that iron butterfly and we'll see what the outcome would have been had we not made the adjustment. Again, the calls both closed out of the money because we didn't move those in the put side butterfly adjustment, but the 31.35 put, well, that would have gotten clobbered because it closed $21.60 in the money. And so we'd have to pay to settle that option, which comes to $2,160. And then finally, the 31.10 put, well, that expired worthless also because that was below the closing price of the SPX. So even though we collected $2,000 initially when we entered the trade, we ended up giving it all back and more for a loss of $160 because we didn't use prudent risk management and apply that adjustment, which got the 31.35 put out of harm's way and rolled it down to 31.10, where it ended up safe as it did in the case where we did the adjustment and made a profit of $582. So the key takeaway from today's video is to share with you the fact that you do not have to be a sitting duck with options income trading strategies. Rather, there are repair strategies that are viable and frequently quite successful that can be utilized to take a trade that would have been a loser and turn it into a nice winner simply by having the knowledge that professional options traders, like the guys on our trading desk, internalized a long time ago when they first started trading options. They know how to apply intelligently designed repair strategies at the right time to turn a loser into a winner.
Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it, would like to learn the details of 3 real world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.